You're now tuned into the Money Level Show.
Hello, everyone. Welcome back to the Money Level Show, where we think, act, and prosper. I'm your host, Daryl Thomas. Today, we have the pleasure of talking with Peter Grandich. How are you doing today, Peter?
See you again, Daryl.
That's good. That's good. So you've been weathering the storms of these markets for a while. And, I remember a while ago, you used to tweet, you would put a post on X and you would talk about the pain you were feeling from the junior market and the junior gold resource stocks and such. How are you feeling nowadays? And what do you think has changed for you in terms of weathering those storms and then coming out on the other side of that?
Well, the key was coming out on the other side. So I first back in 2021 made a decision that gold would outperform both stocks and bonds. So I sold all my general equities and bonds to own physical gold, which worked out real well. It was a buy between 1,300 and 2,000. Got out when I got to 3,500, went into the gold producers because I figured they offered more leverage and how much free cash flow they're going to make, and that was correct. But then I also went big time into juniors and they were lagging. And I went into one where I really got my head handed to me and I had talked about it a lot. So those keyboard warriors had a lot of fodder to play with. But since that time, it's been nothing but superb. I superly backed two or three plays. One just received a takeover last Monday, which was a quadrupling from where I owned it. And then one today, as we speak, is up about 1,300% from where we first started buying. So it's more than made up for it. I'm reminded of this. I'm in my 42nd year. I'm reminded that in past cycles, the junior resource market never lasts as long the bulls as the bears. And I remember that the pain I went through. So I'm optimistic that it's going to continue, but I've gone with a more cautious approach by putting away a certain amount of capital and identifying pure risk capital, which really should ever be going to juniors. One of the mistakes that I made in the past, and I think people still make today, is they may even can afford the financial risk, but the mental anguish that can come from literally seeing something go from substantially up to almost zero in such a short period of time. I think that's the caution that we always need to flash for anyone that talks about junior resource stocks, that this is of the highest risk and it takes a fortitude of both mental and financial tolerance in order to try to be successful in a business where failure is the norm.
Yeah. Yeah, that's really good. Failure is the norm. So I'm thinking about, which I've talked to multiple, experts like yourself on the junior resource stocks, and often hear, every one of them, every stock you choose is not going to hit. But then when you hit, you get like some of the numbers that you mentioned earlier. Um, and sometimes you get folks that just go in and all in on a junior resource company, and then when the project fails, they lose it all and everything. They didn't diversify and such. And so, and it seems like that's something that you've always been educating people against. Like you have to have some risk management techniques and strategies for your portfolio. So could you speak to that? Because I mean, I know that you've experienced some losses in the recent years, but I mean, now you're hitting on some of these where you're getting like some massive gains and such. And you mentioned that this is a hard business. This is like, where failure is the norm. And so could you speak a little more to that from a investor perspective, where how to navigate that? I want to introduce you to Revival Gold. Revival Gold, ticker symbol RVG on the Toronto Stock Exchange. This company has multiple projects in mining-friendly jurisdictions. This is the Mercer project, which is in Utah, as well as the Bear Track Arnett project, which is in Idaho. So when you're thinking about leverage, these stocks can go significantly higher. However, there's no guarantees. There's always risk in this, but I encourage you to go over to revival-gold.com so that you can learn more about this company and this opportunity. Invest at your own risk. Do your own due diligence. Thank you all for watching, and back to the interview.
Well, I'll begin with, and this may rustle the feathers of a few, but it's always been, even though I've been on the outside more than inside in the last dozen years, I'm not, for one part of 25 years of my career, it was one of the most active parts of my life, both from a money management and then corporate communication. But one of the things is it's an industry where if you just listen to the day-to-day so-called expert speaking, you would think no one loses in an industry where so much loss takes place. So I would caution whoever you're listening to, especially if they claim they've been at it a long time, if they don't have their share of lumps, well, there's something pretty well wrong. It's an industry, like I said, very difficult. There is a variety necessary. First of all, again, I'll go back to, you really have to identify capital that you're prepared to lose mentally and financially, part or all of it. Two, buy and hold forever doesn't work, because between 7, 8, or 9 out of 10, and we could pick any 10, and I'm talking about juniors, not somebody that's already has a PEA and is working towards a pre-feasibility. There, the odds are much better that they can succeed. I'm talking about most juniors that haven't even done an initial economic assessment. They may be just pure grassroots drilling, or they're drilling and getting some hits, but there's still a lot of things that need to get done before they get over the so-called hump. Well, 7, 8, or maybe even 9 out of 10 of those won't make it all the way. Now, the good news is, if you can find out of that 1 or 2 out of 10, the ones that do, then you see the returns like I'm having in this other particular company of mine that own, that just early at the beginning of this year, it's up 400 or 500% from. But again, I want to caution that while it's very risky, there is a plus now in this market that didn't exist in the previous junior markets I've seen. And I've seen them since 1984. The last great one was 2010 and 11. We had a little bit around the COVID, but now we're really having the first good one in almost 13, 14 years. What's different this time around is the metal prices are so much higher relative to what it would cost and sustain and look for these things. So there's a lot more leverage in it if you're successful. B, the industry was washed out. I'm convinced there's less people in it today than there was in 2010 or 11. Competition is fierce for those dollars. You only got to look at cryptocurrencies and see that people that, if they didn't exist, who would have been in juniors otherwise, weren't. Then there's the challenge for the juniors themselves. In my old days, there were hundreds, if not thousands, of financial advisors, even what were called stockbrokers back then, who built part or all their business around owning juniors. So a junior resource company, if they found Peter Grandich 20, 25 years ago, they got anywhere from 50 to 500 of my clients also partaking in their company. That's a dinosaur. No one really works that way anymore. And there's a few people that still may do it from commission, and there's probably still a few people that do it for money management fee. But by and large, one of the greatest supporting mechanisms for the junior companies is gone. And they had to find different ways to reach that end user. And it's been much more complicated, also included because of regulation. Here in the States, even at discount brokers now, they don't even allow people to buy, even if it has an OTC symbol but trades on a Canadian exchange. The other good news, even though that might sound as bad news, is we've gotten smarter. People were really left to an individual financial advisor or newsletter writer 20 or 30 years ago. There's an awful amount of knowledge out there on the internet now that people can learn from. Not to say that a lot of chat groups are worth their salt. Oh, they're not. A lot of them are, when somebody's posting 30 or 40 times a day, every day, they're either extremely independent, wealthy, or maybe somebody that maybe you want to pass up on. But there's at least an opportunity now to learn more and understand things that weren't available anymore. The conferences are still good. The group that you're involved with, it's still, I think, from a junior resource side, I don't think there's a bigger conference that takes place compared to what would be in Vancouver. But we have to remember that just because you go in and talk to somebody doesn't solve anything. But I also think we have an investor now, a speculator, that has more education going for them than 20 or 30 years ago. That's why the promoter arm, the people that were, hey, want to buy something quick, that's basically been dissipated. There's a couple on the internet. I see them. There's one I would avoid like the plague. But by and large, I think an individual speculator / gambler has a better chance now in the junior market than they did 20 or 30 years ago.
Yeah, that's pretty insightful. So thinking about, just kind of where we're at in this cycle. So just sticking with gold, and then I want to transition to silver because you had made some calls. I mean, you called the cup and handle on the silver charts and one of our previous interviews. So just thinking about gold, I mean, recently we had a cool off in the metal. Um, I mean, almost hit $4,400 in a span of, I think it was what, 3 months, maybe 4 months, and cooled off, shook out a lot of investors, and now it's consolidating around close to $4,000 an ounce and such. Um, what's your perspective there? Do you think that move was just unsustainable and too fast for an asset like gold? Just curious in your perspective there.
Someone who was managing money and remembering quite well being at a major conference, PDAC, maybe Cambridge somewheres, and going, boy, if gold could just get above 350 or 375, we'd be really happy. And now I heard people this week being disappointed that it was slightly under 4,000. So it's taken some accustomed to that and all. So, like I said, back in 2021, I made a decision that only 0.1% of our clients of our planning group even bothered to listen to. Sell stocks and bonds and hold physical gold for capital gains appreciation. Not because I think the world's coming to an end or there's a monetary crisis, but if you want to make money, own gold, not stocks and bonds. And I stayed with that till earlier this year. Then, like I said, I switched to the majors and then I went into the juniors. We've had a phenomenal move in the gold price. And it was overdue, and I spoke about it, especially when we got above 4,000. In fact, I told our clients who bought it for capital gains purposes. See, if you bought it for a lot of the other fears, monetary upheaval, ability to survive, because I'll have gold versus, other people won't have it, you were able to buy a real cheap insurance policy. Hold it forever. I wasn't one of those people. Things get really bad, I just hope to make it down to my church, not to my gold vault, to hold on to my gold. Having said that, when we got above 4,000 and knowing clients that own it as cheap as 1,300 up to 2,000, I suggest you might want to at least sell 25%. This is a big move. It's not going to be normal. At least it doesn't appear it's going to be normal at this time, that we're going to go up 50, 60% every year now for the next 5 or 10 years. Take something off the top. We're extremely overbought. We've come parabolic. And then, as I put up on my X page, two things hit up. We had a huge bear reversal that day when we fell $250. And we also hit the highest relative strength in the entire history of trading free gold. And so there had to be some sort of corrective and consolidation. And in fact, the longer that we go now, if you still believe in higher prices, the better off you will be. The problem we enter now, as you and I speak here on Halloween, is we really only have 4 more weeks to the year. And people go, wait a minute, Mr. Grandich, you're forgetting about December. No, basically, once we celebrate U.S. Thanksgiving, markets start to dry up. Hedge fund managers, I was one, basically want to keep whatever they locked in gains because their 20% payout is going to be based on that. And they're not going to want to put it to risk in December. So looking for the next 4 weeks or so, I think it would be best. Markets don't always do what you think is best, but we've had a gigantic move in the gold price. There isn't a major out there or anyone that's in the business that wouldn't mind having anywhere from 3,600 to 4,400 over the next 12 to 18 months. 3,600 is probably the downside, the most risk to the downside. And getting back to the previous high around 4,400 is probably the best expectation we can have between now and the first quarter. But keep this in mind. The profitability for major producers is so great when two of the biggest things that normally expenses cost them are sideways to down. Oil prices and cost of having people work for you and all. So they're going to keep printing free cash flow like it's going out of style. And we had a watershed effect, and it was one of the companies I own. We had a significant major, IM Gold, step down and reach out and buy out, make an offer to buy out Northern Superior Resources. We just, as you and I are taping today, have seen another deal announced in Quebec. We're finally seeing significant producers reaching down to yet to be producing companies and buying them out because they're still relatively extremely cheap given what the gold price is. Keep this in mind, Darryl. If you're a Canadian producer, it's $6,000 Canadian gold. Most PEs or even pre-feasibility studies on gold producers that are close to producing in Canada are 2,000 and under. The profitability margin is phenomenal. So that's why I continue to expect this marked increase in M&A, and I think gold will remain relatively strong. What I don't think people should be concerned about, that these bears show up and and there's people. Remember, Wall Street, Main Street, Wall Street thinks of gold is like kryptonite. They are never going to fully get behind it because it flies in the face of what they make their living off of, selling stocks and bonds. But anybody that thinks that somehow we're going back to 2000 or something of that nature, I think is going to be sadly mistaken. I think the risk is 10% lower here to about 3,600 at worst. And then later in 2026, as I think the social and political and economic issues that we're already facing now graduating get worse, that'll get the renewed effort, and we will run to $5,000 gold. That's been always something I thought was realistic. Once people start talking about 10 or 20,000 now, the world that we know is not going to be the world that we're currently living in. And I don't know if I need gold price like that in order for so many people that are going to suffer in that world if we have a $10 or $20,000 gold price.
Yeah. Yeah, you got me thinking of a couple things. I've been looking at the upcoming Supreme Court cases. One is on the legality of the tariffs, and then another is on whether the president could fire a Fed governor. And I'm just thinking, like, what is this going to do for markets when these decisions come out? Like, like something's gonna get impacted for sure. And then I'm also thinking about when you mentioned the acquisitions, the M&A. So recently, Newmont had reported their earnings, and then I think they reported a lower growth projection, and the stock didn't hold up its gains that day and such. And so I'm kind of wondering, like, if some of the majors really need to start looking at some of the juniors and acquiring some of these projects to pretty much so that they can continue to grow and such. And so just want to get your perspective there on the majors and any type of M&A activity for them to continue to grow so that they can continue to generate returns.
Like I said, as we've had the watershed event, let's understand that the majors on average rose triple digit. So profit taking and consolidation shouldn't come as a surprise. What I think was important also is we were having such dramatic moves in gold. They just couldn't get their head. They kept saying, well, let's wait a couple more days. Our share may be up more, because they use their share as their currency. I think what we now have in this consolidation phase is that's what's helping lead this. This takeover that was done today was quite interesting. It was on a Quebec project, and everybody suspected if this project was going to be taken over, it was going to be at least a Canadian producer. But it was a Mexican company that has no interest in Canada. I thought that was quite bullish, that even majors outside are looking at this opportunity. Because remember, the Canadian dollar is the only currency that's fallen against the US dollar this year. So Canadian producers in terms of gold price is very, very attractive. I just think, like I said, I start thinking of 2026. We only have about 4 to 5 weeks tops left of real activity in this market, but I think we'll move into the new year and see a lot more M&A. Again, I'll tell you another thing that I thought was kind of interesting. We saw the news now of what Mali has done in terms of basically booting out or charging such crazy royalties that it's becoming impossible to work in that country. We're now seeing other areas in West Africa as well. We know the problems that several copper producers are having around the world in certain countries, not only from an engineering standpoint, but socially and politically. The world has shrunk dramatically, and this is a very, very important point. I've been a big bull on copper, and I remain very bullish. It's the metal is perhaps the best trading this year because it's trading exactly as I hoped it would. I talked about a 4 to 450 the first half of the year, 450 to 5, finish above 5, and then work higher. So now we have, in the last 12 months, we've seen substantial reports of current key producers losing production ability for one reason or another. Second, we're seeing the demand for copper, as people recognizing, only going higher and higher. And so the copper stocks, the financial institution, big money, was started chasing them. And they chased them and drove up their NAVs to like well over 1.2, 1.3. I've seen some point 1.5. Well, that takes into account a belief that copper is at least going to 6 if you're going to justify owning that stock. Well, what happened is once the market saw that and it stayed, people started to look around. Well, what about some of these soon be producer coppers companies that also have gold? They're trading at 1 or 2.2 of NAV. And we've seen that now. This past week, some of them, including this company that I'm involved in, North Island Copper and Gold, saw tremendous interest because, relatively speaking, they're still cheap. Well, you can make that same argument for the gold soon producers. They're not being priced yet. They're still, yeah, some were done at $60 or $80 the bids, but gold's $4,000. We had 60 or 80 when gold was less than 2,000. So to argue one thing, to say that somehow that the gold stocks, particularly the juniors, are overpriced, no. We're well off the bottom, and some have done well, but it's not a market yet that's become pricey. Certainly not compared to other things like AI and technology and all that stuff. So sideways for the rest of the year is fine for the metal price, for me at least. And then I think as good as you think this year was, next year could even be better for the junior resource market.
Yeah, thanks for that insight. So I want to pivot over to silver. We've covered silver multiple times in the past. You called out the cup and handle pattern on one of our previous episodes, and it's obviously broken out of that. So I've been doing a lot of research on the silver shortages and the demand for delivery and the backwardation of the spot price being higher than the futures contracts and such. And so that kind of added a layer of bullishness to my thesis, like actually understanding that more. And so just want to get your overall perspective on silver right now.
So for many years, silver was always second class in Peter Granich's book. In fact, the old line that I used that used to get the silver bugs really upset at me was I said, owning silver was like kissing your sister compared to gold. Earlier this year, that changed. A lot of things changed fundamentally bullish, some of the things you just touched on and all. Plus, we had this tremendous cup and handle that we saw in gold a couple of years ago, and it broke out. And I felt the same would happen with silver, and it has. I think silver is still a little bit trapped if gold isn't rising. I still think people find it hard to believe that silver can rise a lot without gold going. So if gold's not going, they go, oh, let me just hold off and let me see if I can buy it a little cheaper. But I think the fundamentals have never been better in all the years that I've been in the business. So if you're going to believe in a $5,000 gold, you have to believe in a substantially higher silver price. Now, I know a lot of people get caught up in the ratio stuff, and there does come extremes, but there's nothing set in stone in that. Understand that the changes for why gold and silver are being purchased now is dramatically different than 20, 25 years ago. Silver has really been a big increase in industrial demand. It's not just speculation or people speculating for metals. It's people that need the physical usage of it and all. Same thing with the gold. Gold has been rallying because we just seen it. The BRICS put out news that they expect within a year to 18 months, right in the time frame that I thought, that they're going to come out with an introduction of a new currency. Now, not a currency that's going to replace the dollar in world, but it's going to be used by the BRIC nations to trade. And I suspect that it's going to be have gold involved in it all. That's why they were such huge buyers of it. That will only benefit silver, even if it's not part of it. So any weakness, just like in gold, any 10% pullback in silver from here, I think you still buy it. I think silver can go a lot higher. And there's not as much pure silver plays. I'm just too long in the tooth in age to start to first try to research now individual silver plays. But I do think there are some, and I think where you look for it, the many places that people used to go, South America, Mexico, I find dangerous. My restriction is to North America. I'll have one or two maybe outside that Rome, and even in the United States. Listen, I'm never going to touch anything in California, so it doesn't mean you go anywhere. But there are plays to look at. The Idahos, places like that and all. But I just think if we've had a great move for both of them, we needed a consolidation. Consolidation, the longer it is, the better it is if you want higher prices. And both of them could be an equal proportion. I would have no problem where years ago I would have, if somebody said I own as much silver as I own gold. Okay, I don't have an issue.
Hmm. Yeah, yeah, definitely. Yeah, I'm just thinking about I mean, you mentioned a lot of good points there, and I was kind of wondering about the pressure, the amount of pressure for the physical delivery has been kind of astonishing in my opinion, with the amount of industrial demand, like how much it has picked up. Like I wasn't, I knew like silver was in solar panels and electric vehicles and all of that, right? I knew it was used in many different industries and such. But I did not know that the demand, industrial demand, was picking up so much to where it would like compete even with retail demand and many of um, these vault holdings and above ground supplies are being tapped into and demanded for delivery, as well as like the reduction in the output from mines and such. And so it seems like for me, I'm thinking silver could easily hit triple digits in the next year or so. And so I don't know. I've never been as bullish on silver, but after doing my research and diving in, I'm getting pretty bullish, Peter.
Well, in order to get to $100, you'd be talking about a gold price north of 5,000. That's what would probably coincide with that and all. I'm just knowing that between now and if it's next year or the end of the following year, if gold is 5,000, the things I own now are going to be doing really, really well. And if I'm right that silver then should be near 100, if you own silver things, they're going to be doing very, very good as well. The one thing you don't want, this is the one caveat, you don't want a stock market crash. See, there's people going, oh, I wish we just get a crash. No, because people would just liquidate first and ask questions later, and that would also spill over to gold and silver. What we
Mhm.
want is a rollover. We want that market to basically stop going up and then maybe lose a little and all. Same thing as much as AI is insane and all these type of things, because you want an opportunity for people to kind of switch over. And that's all gold and silver needs now. It just needs a little siphoning from where most of the Main Street money is still going. And that's obviously into AI and even into crypto. And we're
Yeah.
starting just to see some of that leak out of crypto, even though they're trying to talk more now than ever to get people out of gold and silver into crypto because they realize their market is weakening, not the gold and silver market. But don't root for a crash because a crash is not going to benefit anybody.
Yeah, agreed. Agreed. So there's been the acronym TINA come out. There is no alternative. We've also had the narrative of the debasement trade. In the United States, on balance sheet debt hit over 38 trillion for the first time in history. And so want to get your perspective there on how the metals, what role do the metals play with those dynamics? Is there an alternative?
Well, that it's been supported, but I think what's being lost sight in this, and it goes back, and if I may put on our financial planning hat, because that's what's left of the business. I'm involved in a group here in the US. And I've been telling our clients, you guys gals, you have to understand what 38 trillion. First of all, you got to understand, when I entered the business in 1984, we didn't know what a trillion anything was. We didn't use the word trillion for anything. There wasn't trillion anything. Now, of course, there's 38 trillion. But the pace on which it's growing, the Congressional Budget Office in 2023 startled a few back then and said when it was under 30 trillion, that they saw a $50 trillion debt by 2035. Got a little news, a couple people kicked the tires and they went back to the business. Then about a year ago, they raised it to 54 trillion and they dropped a year. They said by 2034. Before the shutdown, there were some people speaking, not necessarily from that group, but that similar to that group, that we could be at 50 trillion as early as 2030. Well, this is what I want to leave your viewers with. This is the simplest, and anybody should get to their financial advisor and hear what their answer is to this. At 50 trillion, if we just use a 5% interest rate, Darryl, historically, that's not a high number. That's $2.5 trillion in an interest expense on a yearly basis. That's got to be met. We, as a country in the United States, did somewhat under 6 trillion in our best year in revenue. So we'd be looking at almost half of all potential income just to pay an interest expense. The country you and I know and live in at this moment will not be able to run in the same way if that much money must go pay our expense. And on top of that, this is what really irks me. Even the Trump administration, who was adamant against it when the Biden administration was in power and talking about it, is now talking about letting certain student debt be reneged. Well, here's the issue, America. Student debt is America's largest single asset on our books. It was 27% of all assets. So if we remove that from the asset sheet, not only do we have that problems of servicing the debt, but now we have to raise taxes somewhere else because this was income we were hoping to get, which we've now forgiven. And someone like me or someone out there that either paid off their child's student loan or didn't take it and paid their way through college, by doing the right thing, we're going to pay twice because now we're also going to see our taxes raised to pay for the people that didn't pay back what they should have. And remember, those people didn't pay a different price. It wasn't like we discovered usury and they were ripped off or they didn't get a chance to get their education or whatever. They did. And then it's the last paramount, Darryl, and I'll close with this. Where do we stop? Do we do that next for the people that are having problems with mortgages? Car loans, consumer loans. So that is the crazy scenario that you can take into metals and what happens and all that stuff and all. But I can tell you this, 98 or 99% of all Americans, and I see it through our planning group by all levels, all colors of skin, or type of income, etc., have no idea what crises lay ahead just from debt. Debt, whether it's on the federal level, state level, consumer level, corporate level, forgetting all the other crises from retirement crisis, infrastructure crisis, aging crisis. So those type of concerns, when you add it all up, paint a very dark picture for me once we get into 2026. And I am the most bearish position outside of my exposure that identified that I can afford risk in juniors, to the point where I only own money markets, T-bills, and CDs, something that never got into such a position before in my life. So take it for what it's worth, but I do think since most people do not understand this ramification of what this debt crisis is going to be like, and it's unavoidable, you just can't say, well, we won't pay it. You just can't. And by the way, let me just add one last thing because I can go on and on over this. A lot of the people that used to help support that debt, our president taking a big stick into a trade war and trying to hit him over the head and break the kneecaps, they're not as popular now wanting to help America or buy our debt. In fact, they're selling off our debt. So we're becoming more dependent on ourselves to finance this debt. And that just complicates the issue. So sorry to end on a really bearish note, but I think it's a realistic note, at least in my house.
Yeah, for sure. Yeah, I appreciate that candor and that realism. Peter, where can people connect with you? I know you're active on X and such, and so where can people ask you questions or connect with you?
This is where I do most of my communication. There is the website, petergrandich.com, and there is a YouTube channel. I don't answer questions that aren't our clients because I would spend all day answering questions from non-clients. But I do from time to time open up my X page to take questions and all. But everything I have to say or do is posted on my X page, whether it's through great interviews like you have with me, some people that I interview, or whatever. My X page is the best place to go.
Okay, cool. Well, we'll be sure to link to that in the description below. Thank you all for watching. Please hit the subscribe button. Love to have your support. And Peter, until next time.
God bless, brother.